We're going to take a look at Tupperware brands, and what I do in my videos is I run my discounted cash flow model to figure out the true value of a company's stock. I also look at the financial ratios of the company and compare them with its competitors. And I do this with you throughout the entire video, so it's like we're doing it together. So let's get started with the model. The company has a market cap of $770 million. And they're trading at $15.72. So that's one share of stock is almost $16. And the way you value a company is you estimate the future free cash flows, and then you discount that dollar amount back to today's value. And that's what I'm doing in this video. And the best way to estimate future free cash flows is to get their actual free cash flows, which is what I'm doing now. I'm putting into the model. We also need the net income, which is a profit and loss on the income statement. Next, we're going to pull the revenue, which are the sales, also on the income statement. Looks like their sales have been going down almost every year, which is definitely not a good thing to see. And in 2017, they had negative net income. Now, if you look on the income statement in 2017, they paid income tax of $450 million, and they only had sales of $185 million. It doesn't seem like it makes sense that you would pay more in taxes than in sales, but the income statement uses accrual accounting. So the income tax it's paying in 2017 could be something way back from a few years ago that occurred. That's why the income statement is sometimes hard to look at. Let's get their capital structure, because we need to figure out the discount rate we need to apply to the future cash flows. The interest they pay in their debt is $42 million. And let's see how much debt they have. We'll go to the balance sheet. We'll go to liability section. And current debt of $273 million, that's debt due within 12 months. Long-term debt of $602 million, that's debt due after 12 months. They pay 4.7% interest on their debt. Let's go back to the income statement to get their effective tax rate, because interest payments are tax deductible. Let's use the 2018 number. Their income before tax was $276 million, and their income tax was $120 million. So the cost of debt is 2.7%. Now let's get the cost of equity. We need the beta, and the beta is how sensitive the stock is relative to the market. And they have a beta of 2.74, so the stock is really volatile. It moves almost 3 times the market. A high beta tends to be a risky stock. Let's go back to the balance sheet to get their current assets, because we need to calculate the current ratio later. And current assets are mainly cash, accounts receivables, and inventory. And that's $538 million. And current liabilities is also part of the current ratio. These are debts and payables due within 12 months. That's $689 million. And they have negative equity, so their liabilities are more than their assets. Let's look at their income statement, because we need their EBIT, earnings before interest and taxes. That's $188 million. Let's look at their capital structure. The cost of debt is 2.7%, and they're 100% debt. So the estimate for the future free cash flows for 4 years is up here, 19, 17, 16, and 15 million. That's based off of the prior financial information. We also estimated a terminal value, which is all years past year 4. That's $1.4 billion. Then we had to discount those numbers back to today using the weighted average cost of capital. That's here in green. And if you sum these numbers up, we get a value of the company of $1.3 billion. We divide that by 49 million shares, and we get an intrinsic stock price of $27. It's trading at $16, so it's trading at a 41% discount. So it's a buy according to the model. Simply Wall Street values them at $20, so they're also saying the company's a buy. Let's look at their historical stock price. So you can see the stock has been dropping off a cliff for a long time now. So it seems like it's a really low point, but there's probably a lot of concern the company may go bankrupt, and I'm sure that would be a concern for me too. And I calculate the chances of them going bankrupt within the next 12 months are 45%. That's why the beta is so high. It's just such a risk. You might get paid off well if the company doesn't go bankrupt and starts bringing in more revenue, but there's a big risk you might lose your entire investment. Let's look at the financial ratios. They have a bad PE, a really good price to sales, and a negative price to book. So PE 62.1 is stock price over earnings per share. So to calculate earnings per share, it's net income over shares outstanding. I like to see below 15, so they're not providing good value for this ratio. They are providing great value for price to sales ratio. That's stock price over sales per share. To get sales per share, that's revenue over shares outstanding. If this ratio is below 1, that's considered a really good value. And they have negative price to book because they have negative equity. They have a bad current ratio and a negative ROE. So current ratio is current assets over current liabilities, so they cannot cover their current liabilities, which is a big concern for the company with 100% debt. Their ROE is negative because they have negative equity. Interest coverage ratio 4.5. Even though they have negative equity and 100% debt, they can cover their interest payments because their operational cash flow is enough to cover that. Let's compare them to another company, Reynolds. They're in the same industry. And Reynolds has a better PE, although both of them are pretty weak in PE. Tupperware is better in price to sales. Tupperware has a better price to book since their negative is a little less than Reynolds Wrap negative. Reynolds Wrap can cover their current liabilities, so their current ratio is above 1. Both of them have a negative ROE, although Tupperware is a little better negative. They're 100% debt, both companies, and Reynolds is 10 times as large as Tupperware. So it seems like an undervalued stock, but it's really risky at this point. Proceed with caution. Thanks for watching.